I found a powerful all-in-one indicator that brings together many core price action concepts into a single tool. This indicator covers almost everything you need to analyze the market structure, key levels, and important imbalances. In this video, I will explain how this indicator works and how you can use it as part of your trading approach. So please watch the entire video until the end. Let's get started. Before I place the indicator on the chart, if you enjoy this kind of content, please support by liking the video and subscribing to the channel if you have not already. This indicator adds a lot of lines and zones to the price chart, which can sometimes make the chart feel crowded and harder to read. To fix that, you can first adjust the chart scale. You can zoom in or out slightly by holding the mouse and dragging up or down. Then apply the indicator. Now, let's add the indicator. Click on Indicators, then search for ICT Concepts. Select the new Multi-Concepts indicator from the list. Here it is. As you can see, many lines, zones, and pieces of information are now displayed on the chart. These are all tied to well-known price action concepts. If you are not familiar with the underlying method, it is a structured way of trading that focuses on tracking institutional-level activity by analyzing how price moves and reacts around key levels. Many traders use this style of price action analysis manually, drawing levels and patterns by hand. This indicator automates the process of highlighting those important zones so you can save time and focus on your decision-making. Bear in mind that this is only a visual aid, not a standalone trading system. You still need to understand the concepts behind each signal and confirm everything before taking a trade. Now let's go through what each part of the indicator shows. As you can see, the first thing you will notice is the market structure information. This method is built around break of structure and change of character, also known as market structure shift. When the price is in a downtrend, making lower highs and lower lows, there are specific signals called break of structure. These are marked by BOS. This happens when price creates a new lower low and then pulls back. The low that forms before the pullback acts as a potential support level. When price comes back and closes a candle below that level, it can indicate that the downtrend is likely to continue. Following that same downtrend, when the last lower high is broken and a candle closes above that high, this is labeled as change of character or market structure shift and marked by MSS. This tells you that the prior downtrend structure has been broken and there is a higher chance that a reversal is taking place. In an uptrend, the price makes higher highs and higher lows. When price pulls back, the previous high acts as a potential resistance level. When price breaks above that high and closes a candle past it, this is called a breakout of structure and labeled BOS. This can signal that the uptrend is likely to continue. Similarly, after an uptrend, if the last higher low is broken and a candle closes below it, this is also marked as market structure shift. That can be an early sign that a downtrend may be starting. Next, the indicator shows order block zones. Order blocks are price ranges where institutional and large-size traders have previously entered or exited the market. In other words, these are areas where a large number of orders were executed, creating a strong imbalance between supply and demand. That imbalance often leads to significant price movement. The indicator automatically identifies these zones and marks them with red and green areas labeled bearish order block and bullish order block. A red zone like this one is a bearish order block, and the green zones are bullish order blocks. These can act as powerful support or resistance levels in the future. When price approaches a bearish order block, you might expect it to pause and then move lower. When price approaches a bullish order block, you might expect a pause followed by an upward move. These zones can be very useful for planning entries, stop-loss placements, and profit targets. You will also notice other zones on the chart that are not labeled as order blocks. These are fair value gaps. A fair value gap is a pattern made by three candles, where there is no overlap between the shadow of the first candle and the shadow of the third candle. The space between these shadows is called the fair value gap, and it represents a short-term imbalance between supply and demand. Traders often use these patterns in pullback strategies. Bearish fair value gaps are shown in red, and bullish fair value gaps are shown in green. In this section of the chart, for example, the indicator did not identify any bullish fair value gaps. Another useful feature of the indicator is how it marks liquidity sweeps with horizontal lines. For example, imagine traders who took short positions at this level. They would likely place their stop loss above this recent high, since a move above that level would suggest their analysis was incorrect. Short positions are closed by buying, so stop loss orders placed above this high create a pool of buy orders in that area. Institutional traders are aware of these clusters of stop loss orders and sometimes move price into them to trigger liquidity. Once that liquidity is swept and most of those buy orders are filled, price often reverses sharply and heads lower. A similar pattern can happen on the sell side, where a liquidity sweep is followed by a strong move higher. The indicator also plots Fibonacci levels on the chart. If you use Fibonacci retracements or extensions in your strategy, you can keep these levels visible. From the Settings panel, you can adjust which Fibonacci levels appear. Scroll down in the Settings, and you will see options for Fibonacci. You can even add 2 extra levels if your strategy requires them. If you scroll up in the Settings, you will see options for imbalances. By default, fair value gaps are activated. Instead of fair value gap, you can select BPR, which stands for Balanced Price Range. This occurs where a bullish fair value gap and a bearish fair value gap overlap. It marks an equilibrium zone that can signal strong continuation or a sharp reversal. Another option you can enable is CE, which is Consequent Encroachment. This is the midpoint of a fair value gap and often acts as a high probability magnet for price. Depending on your strategy, you can choose which of these features to display. In practice, you may not need all of them at once, so disable the ones you do not use. This all-in-one indicator pulls multiple concepts into a single layer, so you no longer need several separate tools for structure, order blocks, gaps, and liquidity. It simply makes the process of identifying key levels faster and more consistent. However, it is important to repeat that this is only a helper tool. It is not a buy or sell signal generator. You still need to know the underlying principles, analyze context, and validate the levels it highlights before making any trading decisions. That's it for this explanation. Thank you for watching. If you have any questions, feel free to leave a comment and I will do my best to answer. If you have not already subscribed, please subscribe and turn on notifications so you don't miss future videos. I'll see you in the next one, and good luck with your trading.